Why invest in bonds? Bonds play a crucial role in portfolio diversification, providing a counterbalance to more volatile assets like stocks. This diversification helps mitigate overall portfolio risk, as bonds often perform differently from stocks in various market conditions. One of the primary attractions of bonds is their ability to generate predictable income streams. Typically, bonds pay interest at regular intervals, offering investors a steady cash flow. This feature makes bonds particularly appealing to retirees or those seeking consistent income from their investments. Bonds also offer capital preservation when held to maturity. Investors who purchase bonds and hold them until they mature can expect to receive the full face value of the bond, barring any default by the issuer. This characteristic makes bonds a valuable tool for preserving wealth and managing risk, especially for those nearing retirement or with shorter investment horizons. Pros of investing in bond: stability and lower risk. Compared to stocks, bonds generally exhibit lower volatility and risk, particularly high-quality government bonds. This stability can provide a sense of security for risk-averse investors or those looking to balance riskier investments in their portfolio. Potential for higher yields: bond yields often surpass interest rates offered by traditional savings accounts, certificates of deposit, CDs, or money market accounts. This higher yield potential makes bonds an attractive option for investors seeking better returns on their fixed income investments. Tax advantages. Certain types of bonds, such as municipal bonds, may offer tax benefits. The interest earned on these bonds is often exempt from federal income tax and sometimes state and local taxes for residents of the issuing state. Diversification benefits. Bonds typically have a low or negative correlation with stocks, meaning they often perform well when stocks are struggling. This inverse relationship can help smooth out portfolio returns over time. Cons of investing in bonds: interest rate risk. Bond prices have an inverse relationship with interest rates. When rates rise, existing bond prices tend to fall, which can negatively impact the value of bond investments if sold before maturity. Inflation risk: fixed-rate bonds are particularly vulnerable to inflation. As the purchasing power of money decreases over time due to inflation, the fixed interest payments from bonds may become less valuable in real terms. Credit risk. There's always a possibility that the bond issuer may default on their payments. While this risk is lower for government bonds, it can be significant for corporate bonds, especially those with lower credit ratings. Potential for lower returns. Over the long term, bonds have historically provided lower returns compared to stocks. This means that an overly conservative portfolio heavily weighted in bonds might not generate sufficient returns to meet long-term financial goals. Liquidity risk. Some bonds, particularly those that are not frequently traded, may be difficult to sell quickly without incurring a significant loss in value. In conclusion, bonds offer valuable benefits such as income generation, capital preservation, and portfolio diversification. They can serve as a stabilizing force in investment portfolios, particularly during times of market volatility. However, investors should also be aware of the potential drawbacks, including interest rate sensitivity, inflation risk, and possibly lower long-term returns compared to stocks. The decision to invest in bonds should be based on individual financial goals, risk tolerance, and overall investment strategy. For many investors, a balanced approach that includes both stocks and bonds can provide a solid foundation for long-term financial success.